Let's get right to it. Today we are breaking down your 401k in a way that cuts through the confusion and gives you real clarity. And today isn't about forecasts or guesswork. It's about understanding the system, helping you make smarter decisions, and giving you the confidence to build around your retirement strategy. And if you've ever felt unsure about what to do with your 401k, you're in the right place. So let's start with a quick foundation. Now, everything we covered today is educational. It's not personal advice. Every situation is unique, and your decisions should reflect your own goals, income, and circumstances. Investing involves risk. Nothing is guaranteed, and my job today is to give you the framework to make smarter, more informed decisions. Let's set that tone. This is something that I have to put, being I'm a registered financial advisor. And to break the ice and make things not as dim, a little humor to start, because sometimes it feels like you need a genius or a mathematically gifted cat just to understand the market. Fortunately, you don't. And today it's all about removing that complexity, not adding to it. And investing comes with emotion. Some days feel smooth, other days feel like slipping on ice, but the goal isn't to eliminate emotion. It's to understand it and make decisions that stay consistent regardless of how the market feels. So let's dive into it here. Now, markets have always been unpredictable. There's highs, there's pullbacks, there's rallies, and then it repeats. A lot of people are wondering if they should be doing something differently with their 401k. And if that's you, you're not behind. You're paying attention. And it's times like this to bring structure to that uncertainty. And there's no reason to feel any guilt. It's completely normal to feel hopeful and uneasy at the same time. You don't need to ignore your emotion, but what you do need to do is put a plan in place to help outperform your emotions. And once you understand that, you're going to remove the panic and replace it with consistency. And I want to make something clear that no one knows what the market's going to do next. But the good news is you don't need a crystal ball. You need a system, some sort of framework, and a repeatable process that works in good markets and the bad markets, because you can't have the good without the bad and the bad without the good. And that's exactly what we're building here today. And with your 401k, you only control 3 things inside of your 401k. One is your fund choices. Second is the contribution settings. And third is if you have an old 401k, what to do with it. And that is it. You have 3 levers, and you need to focus on these instead of the noise that's going on in the world. And when you start doing that, it becomes a lot clearer on what you can do versus what you have no control over, which is the markets itself. One of the other options you have with an old 401k is you could take it lump sum and have a lot of fun. Wouldn't be a recommendation to do with your old 401k, but you do need to know all the options. Is keeping it where it is. You could take it lump sum and put the money on a rocket ship and have a lot of fun. You can convert it to a Roth, all of it or a portion of it, and you could move it into a new 401k as well. And by breaking down and figuring out exactly what your choices are, confidence isn't going to come from predicting what the markets are going to do. Confidence is going to come from keeping it simple. And when you start to focus on the few things that matter, not the dozens that don't, you're going to start taking control of your financial life in a way that most people never do. So let's break down what those levers are. One of the most common things I see is investing in the target date funds. And most people end up in a target date fund because that's typically the default choice. They're convenient. You look on your 401k benefits, you're like, hey, I want to retire in 2045, and I'm going to pick the 2045 target date fund. I mean, that's super easy decision. But convenience and alignment don't mean the same thing. So before you start relying on any strategy, you need to understand where a target date fund may fall short. And here is that issue. Target date funds reduce your stock exposure as the market goes up, because each year it's decreasing the amount of risk that's going on in the markets and with your money. So in those downturns, so if the stock market went down in 2025 rather than up as it is today in November 2025, in downturns they shift into the bonds, and that's when stocks are potentially on sale. So the target date funds aren't wrong, it's just automation. But automation doesn't mean personalization. And you deserve alignment, not autopilot when it comes to your investments. And when it comes to your investments, this is how most investors act. When things are going up, everyone gets very happy. And then when things go down, everyone gets very sad. However, as an investor, you actually want to flip your mindset. When the markets go up, that means things are getting less affordable. When the markets go down, that's actually the time when having a strategy and a system in place will separate yourself from those who are just winging it and not paying attention to everything. So if you're looking for stability, and if stability is the right choice for your financial strategy based off what you're looking to do with your financial plan, essentially, I would consider potentially moving your funds into a balanced fund. What did I say? I was about to say blended fund. Balanced fund. But they are a blend of stocks and bonds in a way that smooths the ride and reduces those big swings. They're simple, they're predictable, and they keep you invested, which is the long-term success requires. Essentially, you don't want to be just jumping off the ship and attempting to get back on the ship. That's extremely hard to do. And there's a lot of research and data out there that shows that getting in and out of the market doesn't work well for the investor over the long run. So the balance fund, essentially what it's going to do is it's going to reduce your stock exposure, increase your bond exposure. So it's going to help give you some more stability, but that doesn't solve what you should possibly consider for your new contributions. One thing I do want to talk about though is before I go to the next slide, in 2022, we were in a rising interest rate environment, and that negatively affected balance funds because they have this bond exposure. So when the interest rates went up, the bonds also went down in price and the stocks went down in price. So it was like a double kick. So it didn't really work well in a rising rate environment. So if our interest rates are rising, then we want to be cautious of this approach. However, as of right now, we're in a interest declining climate because of all the uncertainties that are going on and everything like that. So I would see this as a potential choice depending on your overall situation. So this is definitely something that you overlook. So let's just say you make strategic changes to your current funds. You got to figure out what are you going to do with the contributions. The new money that you're going to be putting in is just as important as your current balance because you can't just put those dollars into anything. Where you put your dollars matters, and figuring out what your time horizon is when you're looking to retire, that'll make all the difference when it comes to where you want to put your funds. So for example, and this is just an example, let's just say you shift into a balance fund and you go into, a mix of stocks and bonds. For your future contributions, you got to figure out, hey, do I want to put that more into growth for the long run? So if you have a long time, hey, maybe I'm going to throw some darts at the wall and figure out what to do. Or do I want to just, play it steady and then figure out what you could possibly do once you have a better idea what the investment climate looks like? Because your contributions are going to come in every single paycheck, and that means you're automatically buying whatever the markets are doing. So essentially, you're not choosing or you're not timing the market. You're figuring out when is the best time to buy and when is not the best time to buy. We really don't know. And that's by adjusting your allocation isn't reactionary. It's all about being intentional based on where you are in your financial journey. So for example, with the balance fund, let's just say with your future contributions, you're like, hey, I'm a long-term investor. I got a long time. My 401k is still active with my company. I'm going to put my future contributions all into, let's just say, an S&P 500 fund, for example. So you've gone into a balance fund, and let's just say the stock market goes down 25%. That'd be a little scary. You would have protected yourself on the downside, and your contributions are still going into the S&P 500, so you'd be buying as the market gets more affordable. So that's also a good thing. On the flip side, let's just say the stock market goes up 25%. You're giving yourself that downside protection, but you're still going to participate in the market. You're just not going to see the same sort of returns as the market because you've taken some risk off the table. But this gives you some wiggle room, and it eliminates the guesswork on what you could potentially be doing with your money. So, basically, if the market goes up, great. I'm still participating. If the market goes down, cool. I took some risk off the table and I'm, slowly bringing money back into the market over time. One caveat of 401ks, some people don't always realize, is the trades in your 401k don't happen instantly. They execute at the end of the day. It's not the greatest system. It's just how the system works. So make sure you understand that so it won't catch you off guard. So if you end up making adjustments after 4 o'clock Eastern time, those adjustments aren't going to go in until the next day. So that's one of the downsides of 401ks is things don't happen in real time. So that could be something that you think about before just making these changes, is knowing when those changes are going to go in and making sure you're not just becoming active and moving this and moving that and pushing buttons all over the place. We want to make sure that we're staying consistent when it comes to the strategy and putting some thought into it, kind of like mailing a letter and sending a text message. And if you have old 401ks, could consider an IRA. It gives you more control, more choices, real-time trades, access to different types of investments. And with more control becomes more responsibility. So if you think about it, it's kind of like upgrading from a basic car to a high-performance machine, or from like a bicycle to a motorcycle. You get more power, but you need to know how to handle that power. You got to embrace everything, because the last few years have been very strong for investors. And when things feel good, that's often the moment considering rebalancing with intention. Not to like retreat or overhaul your entire plan. There's like a saying out there, you can't climb a smooth mountain. You want your highs to be higher and your lows to be higher as well, because growth isn't going to come from perfection. It's going to come from your discipline and staying steady over a long period of time. And that's where balanced funds could help you grow steadily while reducing emotional spikes. They keep you invested through volatility, and they allow you to adapt without abandoning the strategy. And adaptation is what beats perfection. You don't want to be focusing on perfection, because investing is definitely not a perfecting game. If you're someone who's a little bit closer to retirement, a balanced fund might be too much risk. If you're someone who's a long ways from retirement, balanced fund may be too little risk. So it's all about figuring out what is the minimum investment that you require in order to achieve whatever financial goal that you're looking to achieve. Because things could feel uncertain, kind of like driving in fog, and you don't need to see the whole road. You just need to see the next few feet in order to keep moving forward. So with that clear system and with minor adjustments along the way, you can stay in control even when the visibility gets a little bit low. And here's one of the simplest ways to think about your strategy. Cruise control, that would be like a balanced fund. The fuel, that would be your contribution. Lane changes, those are going to be like your intentional adjustments. Smart investing isn't reactive, it's intentional, deliberate, and centered. And then sometimes you're driving and a police officer shows up, and what do? You hit the brakes. The market goes down. You're like, oh, I need to get out. However, if you're on cruise control and you're going an acceptable speed, you don't have to worry about hitting those brakes. It'll allow you to embrace that uncertainty, because nobody knows what's going to happen next. But preparation beats prediction every time. Having a consistent plan, clear levers, a proven framework, and this is how you build a real financial confidence even when the headlines get noisy. And congratulations, you made it through a financial webinar and you smiled anyway. And if you're here live with me today, we're going to do our question and answer section next. If you're here virtually and you have additional questions, you can send them to this QR code on the left. If you want to consider booking a consultation, feel free to use the QR code on the right. And if you end up hating me during the consultation, I'll give you your money back.